is that we have something called Prop 13. And what Prop 13 says is that your property taxes are pegged at approximately 1% of your acquisition price, and they can only increase by 2% a year. Doesn't matter what the actual value of the building is doing. The property taxes can only increase 2% a year. Now, people who know about real estate know that your property taxes are by far your largest operating expense. And so if you have an environment where your rents are increasing quickly because of the supply-demand imbalance, and your largest single expense line, your property tax, cannot increase faster than 2% a year, what you have is almost guaranteed margin expansion over time. That combination is just spectacular. And so,
welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am today's host, Nathaniel Leach. This is my business partner, Dan Weiss, and we have our guest today, Moses Kagan.
Previously on Critical Thinking Required.
If you own high quality real estate in a high quality market like Los Angeles, the way that you lose is that you are forced to sell at an inopportune time. So what we do is we say, look, the equity, the investors are signed up to hold these things permanently. So the investors are not going to call us up and say, hey, the market's down, we got to sell, right? Like that, no. And we minimize the use, or we use debt relatively conservatively so that we don't end up in a situation where we can't pay the loan and therefore the bank can force us to sell. So the whole business is sort of designed around not about avoiding those kind of catastrophes.
This is part 2 of the episode.
I can relate to that. Dan and I can relate to that.
Yeah.
So I mentioned earlier about, I'd like to talk more about LA. So what led you to developing your niche in LA's real estate market? What drew you to LA besides the great weather?
So I want to first start out by saying that this was not like the result of like some careful strategic analysis by like a Bain consultant or something. This was like, we found a building we were living in LA and we found a building that seemed like it made sense. We bought it. Later, so I guess I should start out by saying, I love Southern California. Southern California is a really difficult place to be. I mean, obviously the weather is amazing, the geography, the access to opportunity. Like there are places with good weather and then there's places with opportunity, but it's hard to find a place that kind of combines the two. So like I'm like just totally sold on Southern California in general, and LA in specific and I've been sold on it since I visited for the first time, and it's just fantastic and everyone should live here. The problem is, and the problem for everyone, and the plus from the perspective of an investor in LA is that for various reasons having to do with NIMBYism and the historic zoning code here and all this kind of stuff, LA is incapable of producing the amount of housing necessary to keep up with demand. Just to kind of give you a sense, like Phoenix right now, I think is building like an equivalent to 10% of their total apartments in 1 year. Okay. LA builds like 1% or 2% or something like that in a good year. It is really hard to build here. Okay. And so just like, I mean, real rents and values are subject to supply and demand, just like anywhere else. So like if you have ever increasing demand among affluent, ambitious, motivated people to live somewhere, and you do not create enough supply for them, you will have rising rents and values. And so you want to be on the right side of that. That's a fundamentally great dynamic. And then there's something else going on, which is I think underappreciated generally about real estate investing in California. California has a reputation of being extremely business unfriendly, which is true. I mean, California is a terrible place to do business in a lot of ways. However, it is Shangri-La for real estate owners. And the reason is that, or one of the reasons is, in addition to the supply and demand imbalance that I just talked about, is that we have something called Prop 13. And what Prop 13 says is that your property taxes are pegged at approximately 1% of your acquisition price, and they can only increase by 2% a year. Doesn't matter what the actual value of the building is doing, the property taxes can only increase 2% a year. Now, people who know about real estate know that your property taxes are by far your largest operating expense. So your revenue is rent, and you got a bunch of expenses, taxes, insurance, maintenance, landscaping, all that stuff. Property tax is the biggest one. And so if you have an environment where your rents are increasing quickly because of the supply-demand imbalance, and your largest single expense line, your property tax, cannot increase faster than 2% a year, what you have is almost guaranteed margin expansion over time. In other words, your building will become more profitable over time. And there are a few other states that have similar setups, but none of them are as dynamic economically as California is, or have the same kind of supply constraints. So that combination is just spectacular. And so a ton of families have recognized this over the years, smart families, very often immigrant families. They buy one building and then they refinance and they buy another building, and then they buy another building and another building, and they don't sell them. And the families that have done that in Southern California over the last multiple generations have done incredibly well. And so in one sense, you can see our business as just an attempt to replicate for normal people, for normal wealthy people who want to invest. And it's an attempt to replicate for them this strategy that has worked so well for just smart, wealthy families in Southern California for so long.
As you were speaking about these combination of factors here, I then got to start thinking about zoning in that throughout nationally, but also I believe specifically in California and LA, there is this zoning issue whereby like they have rules about how high a building can be, or how wide the
so complicated parking,
right,
heights, open space, you name it. Yeah.
So what is your feeling, perhaps as both an investor and as somebody who's for progress? What's your opinion on zoning in general, be it LA or nationally? Like, should these zoning restrictions be loosened such that the supply can meet the demand for housing?
100%. Yeah. I mean, what the situation that we find ourselves in is it's horrific public policy. I mean, it's not even a question. No one who is intellectually honest can look at the situation that we find ourselves in nationally or in Southern California with respect to zoning and supply growth. No one can look at that in a fair-minded way and be like, this is okay. It's not okay. I mean, you look at it from a number of different perspectives, like wealth inequality. Like, it's fucking crazy that someone, buys a house in 1980 and now they're a bajillionaire. And meanwhile, a new, for doing nothing besides holding on to the house. And meanwhile, like, new people can't afford to live here, or that same person's kids can't afford to live here, so they have to move out of state. So there's like an inequality element. There's even, honestly, there's a national security element to it. There's a paper, and I'm gonna blank on its name, but you guys can Google it, that looks at the effect on national GDP, on America's economy, of restrictive zoning in just New York City and San Francisco, and you might as well add LA in there too. They just looked at New York and San Francisco. There is a measurable impact on American national economic growth from restrictive zoning in our most productive cities. Because it turns out that productive people are at their most productive when they're around other productive people. And if you create these artificial supply constraints wherein productive people cannot work together, you depress overall economic growth. And it is horrific public policy. On the other hand, it benefits us, right? Like, we own a building. My favorite example, we renovated and own and will own forever a building in Glassell Park that is, I think it's 7 units, but it could be 9. That's honest. It was built in like early 1960s. And then the area was immediately downzoned. Basically, the neighborhood was like, saw like this guy build an apartment and was like, fuck that, no more. Okay. And so now we are this one apartment building and the rest of the area is single family homes. And it is literally illegal to rip down any of those homes and build a building to compete with us. It is tough to imagine a better moat from an investment perspective than that, right? That is Warren Buffett talks about moats, like that's a moat. You will go to jail if you try to build an apartment building in that neighborhood now. But we get to own ours and operate it. So again, a horrific public policy, very good for investors.
That's just fascinating. So that then leads into my next question. What kinds of I don't want to get too much into the macro, but like what kind of opportunities are you seeing for your business today in the multi-residential real estate market?
Yeah, to be honest, I mean, I wish I had better news. The prices are out of whack right now with prospective returns, in my opinion, are too low. So to give you a sense, like until last year, we had been basically buying or overseeing, because we did some fee deals too. But if you blend in all the deals that we've done, like been associated with, basically, we've been buying a building every 6 weeks for for 9 years or something. Okay, maybe more, maybe 10 years. We've only bought like 2 or 3 buildings in the last year. So our pace has slowed down dramatically. And that has to do with, there's been a flood of capital in. The environment for renovating buildings has become much worse. LA, the wheels fell off LA city government during COVID. Like they let everyone work from home. And I mean, city bureaucracy is difficult to deal with in the best of times, but you send a bunch of people home to work from home and like, good night. Like it has been a terrible environment for permitting. As you guys, I'm sure, are aware, there have been all kinds of supply chain issues about so purchasing the stuff that needs to go into the buildings. So it has been a rough environment for buying stuff. So we have been able to pick off a few deals here and there that do not require as much in the way of renovation, but which are just mispriced for various reasons. And so we've been buying those with investor groups, but the pacing has been slow. And then as interest rates have shot up over the last, call it 3 months, or maybe it's even a little bit more now, things have got worse because, you can, buyers always become aware of the impact of interest rates before sellers. Sellers are like, oh, my building was worth 6 million 3 months ago. Why are you telling me it's worth 5.5 now? And it's like, well, I mean, I'm going to use a loan to buy your building and the loan costs a lot more. And I'm just looking at the cash on cash return here. And like, I'm sorry, it's not like a claim about intrinsic value or something. It's just simply that I can't generate a yield that will be sufficiently attractive to my investors to make it make sense for them to invest. So we have found a few situations where owners are more reasonable. Some off market, some because they've been on the market for a long time and they finally just get sick of it and they're willing to take a reasonable price. But in general, people are sending me stuff every day and it's like, nope, not even close. And brokers get angry at us. It's like, I've got this great deal for you. And you're like, listen, like, I'll pay you like 80% of what you're asking, but I'm sure your seller's not going to take it. So it's honestly kind of frustrating. But that's okay. I mean, we built our organization with these kind of periods in mind. And we'll wait, and hopefully eventually these new higher interest rates will result in prices declining and prospective returns getting better. And then we will buy in force. We will, when the numbers are right, we will go very, very quickly. But I should say, I mean, it's, and this is maybe a reasonable thing to talk about as well. You don't want to be shaking people's lapels and telling them that they need to invest on a timeline, on like a deadline. You know what I mean? So one of the reasons that I continue to engage on, we have a lot of people who want to give us money. We have way more, in other words, we have way more investors who are interested than we have deals to put them in right now. But when things get bad, and I don't know if they will or not, who the hell knows, but if things get bad, what happens is most people get afraid. And a lot of those people who were like, oh yeah, I'd love to invest, suddenly they're like, they saw their 401k half or whatever, or their whole value of their home comes down, and they understandably get nervous. And we have built our entire business around being ready to deploy very aggressively in those situations. And so we continue to want to meet people who have arranged their financial affairs such that they can be aggressive countercyclically as well.
I think what would be helpful, Moses, for a lot of those listening, you spoke a little bit about this in the beginning of the podcast, is some more understanding about what is done elsewhere compared to what you've done. You've talked a lot about that, more so because people don't know what to look out for. What other practices in the industry perhaps do you see that people just need to strongly consider? Not necessarily saying they're bad or good,
Yep.
but that people can get in trouble with perhaps, or they don't understand enough. What advice would you give in that realm to perhaps like a first time investor in private real estate?
Yeah, I got a lot to say about this, and I'm glad you brought it up. So the first and most important thing to understand is that as a prospective investor, you are operating at an unbelievable informational disadvantage to the sponsor, to the GP. And I say that because the difference between a deal that is great and one that's mediocre, or even worse, a deal that's mediocre and terrible, can be like a couple of $100 a month of rent per unit. And it is unless you like happen to be an expert in the particular area or asset class that the sponsor is operating in, you as a prospective investor, there is no chance that you are going to come to a view about whether the sponsor's projections are correct. And as hard as that is, because at least maybe you can like look on Zillow and see if the rents make sense. There is no earthly way that you're going to know about whether his construction budget or her construction budget makes sense. You're not going to like. Sponsors can play hide the ball and just screw up, not because they're being fraudulent, just because they don't know anything or don't know better. These things are so complicated that there's so much information that if you are not a pro, you have no hope of avoiding being bamboozled by someone who is a fraudster, or just like taken down the path by someone who doesn't know what they're doing. So what you need to do first and foremost is to diligence the operator. You're not going to come to a particularly sophisticated opinion about the deal, but you can come to a reasonable conclusion about the person who's overseeing the deal. And you can do that by things like looking at their track record, talking to brokers that they've transacted with, asking to talk to other investors who've invested with them before. All of these things, they're probably asking to talk to their CPA or attorney. Like, no, and I mean, look, you may come across something that's like obviously fraudulent or whatever, but most likely you won't. But you ought to be able to start to come to a kind of a view about, do you trust this person? And ultimately, that's what it comes down to, because again, the deals are complicated, and also all kinds of unforeseen stuff happens. Just like, you name it, the contractor runs away, something unforeseen problem emerges, like you have to replace a sewer that you weren't expecting to replace. Just interest rates go nuts, the rental market crashes or goes crazy. Like, there are so many things that, and you are not fundamentally in a position to control anything. You're relying on the sponsor to control it, and so to act as sensibly as he or she can act. And so again, like it really comes down, people say bet the jockey, not the horse. Like that you're like 90% of your effort should be in looking at the deal should be directed towards getting a view about the trustworthiness, experience of an organization of the sponsor. The other thing right now to look at very closely, particularly for any deals that involve construction, is leverage. With interest rates going like this and construction prices going like this, and maybe rents will go like this, but maybe they won't. If you're highly levered, it is very easy to find yourself, and by highly levered, I mean, there are people out there right now who are using 80% loan to cost bridge loans. Okay. And those loans will have like a 1 to 2 year time limit on them. Okay. And if the numbers are wrong, if the guy guessed wrong about the rents or the construction prices, or even if he didn't, if he gets it right, but interest rates move even further, it is very easy to find yourself in a situation where the equity investment is wiped out. In other words, you can't sell it for what you're in for, and you can't refinance it because the bank will look at the debt service coverage and or the value and say, forget it. We need you to put more equity in, more cash in. And so you can find yourself in a situation where you're like, oh, I'm going to make a $50,000 investment. And then a year and a half later, the guy comes to you and says, listen, we're asking everyone to come in for another, we need you to put in another 25,000. Otherwise your 50 is gone. And if you don't put in the 25, we'll get the other guys to do it, but your ownership stake in the building is diluted. That's the kind of stuff that can happen right now from highly levered deals. So I think I would say 90% focus on the sponsor. And then to the extent that you're going to look at the deal, it's really, really important right now in particular that you want like stuff where the leverage is reasonable. We were sort of fortunate to start our business kind of in like the ashes of the Great Recession. And I just saw these people. I'll tell you I almost said funny story, a horrible story. I met this syndicator, and honestly, he looked like a zombie. I'm not kidding. This guy, he had spent like 20 years syndicating real estate, I think like apartments and office in Southern California, all the way up through like 2006. And he had made a lot of money. And in 2006, the guy's like, okay, we're going to sell out, but I don't want to pay taxes. So we're going to 1031 into an industrial portfolio in Indianapolis. So he basically sold all of the Southern California assets that he and his investors had accumulated over whatever it was, 20 years, did a highly levered 1031 exchange into this big industrial assets in Indianapolis. And then the world fell apart and they lost everything. Gone. And so, you can't meet a guy like, I'm telling you, like even I met him a few years later and it was like meeting a trauma victim or something. Like a spark had gone out of him as a human being. And you can't meet too many people like that before you're like, okay, like that, I do not want to be that guy. And so anyway, that's where a lot of this thinking comes from. And like I said, it hasn't been economically optimal for the last 10 years. Like being levered up to 80% and all that stuff has been great for the last 10 years. But but eventually, you know, things change, and I'm just like, I don't want to be that guy.
That is one hell of a true fear that I think that every investor should go in with. Absolutely. So I think that with that, we're going to roll it up from here and go into what we like to call our round robin. So I'm going to start, and then Dan, and then it's going to be you, and then I'll close it out. So a couple things that jumped out at me. Compounding is a powerful force. Don't ever underestimate it. And I'm sure that taxes probably enter the mix there in taking away from that compounding power. So being mindful of that tax efficiency. I really like the piece about when you put together being an entrepreneur plus, as I would term it, thinking critically. So you made a lot of mistakes, true, but you came at it from an outsider's point of view. And as a result, there has been different ways of doing things than outside of the norm, and it's worked for you. I think that's what's important. You spoke about a combination of real estate factors within the Southern California, LA area that essentially created what we, as I'm sure you're aware, is called a Lollapalooza effect, term Charlie Munger. Because of those factors, they create a outsized return as a result. And I think that that's a great lesson for our viewers and listeners, because of the understanding that if you find a few core principles that can bind together a business idea, be it a moat, using your example of that one apartment building where it's now illegal to build, that is a very micro example of what I'm talking about, to the effect of you find something like that, you have to know when to swing the bat, as Buffett says, to hit that pitch and hit it hard. And I think that that's a fantastic lesson. But correspondingly, there can be a great deal of stress, risk, heartache involved with that you have to be mentally prepared to deal with. And if you have to ask yourself, am I mentally prepared to do that? And I think that speaks to those tips that you were talking about with a prospective investor, is to, I would, from what I heard you say, I would phrase it as accept what you know and what you don't know, and understanding what you as an investor are comfortable with. If you have a healthy fear of losing your money, then perhaps it's to your best interest to maybe not do these kinds of investments, even though maybe your next door neighbor or your best friend is doing them. What works for them doesn't necessarily work for you. Is how I would phrase it.
Yeah.
Dan?
I think there was so much good stuff said here that for a second, I thought, oh God, I'm going to be able to give some points out and not repeat Nathaniel. I came close. So we'll start with that. So like a moat, we don't hear enough about that. This is my repeat on you, Nathaniel, that whether we're talking any kind of investing, it really should be talked about, because nobody and no deal is invincible, but some are more so than others. So it's really important to think about. You also mentioned too, Moses, about timeline too, and not being pushed around by someone else's timeline is what I heard you saying. That's hard to do until you get used to it and until you're in a position where you can do that. But it's a ginormous advantage to be able to go off your timeline. Everybody, you have your own timeline. Someone starts pushing you around your timeline, you're bound to make mistakes. And that is something that could be more devastating than missing out on something. So timeline, really critical. I'm so glad that you talked about that piece. And then I guess my last just comment before Moses takes us home on this is just that sometimes, non-traditional paths, whether that's, us in our situation or Moses and his background getting to where he is, they can really lead to some very unique perspectives. Either that works out beautifully or not. But when it works out beautifully, and we often do see that, it really is. It's really a credit to your legwork and really challenging norms to find out what really makes sense for your own truth, like Nathaniel said. So, Moses, what would you like to end with?
Yeah, well, first of all, I'd like to end by thanking both of you for having me on and letting me talk to your audience. I love these kind of conversations. You can probably tell I'm a major real estate nerd, so I find these conversations kind of energizing in a way that I think a lot of people don't, including like my wife, who's like would like me to shut up about it. So thank you for that. And then I guess. The thing that I would say is just to reiterate that the advantage in any kind of investing, one advantage that individual people can have against institutions, against highly sophisticated real estate private equity firms, against hedge funds, whatever, is the ability to invest with a very, very long time perspective, time horizon. You're not, because no one, like, unless you put that pressure on yourself, there's no outside person coming to you quarterly and saying, why isn't this working? Like, give me my money back. Like, you know what I mean? So for me, what makes sense in investing, and I think what makes sense for a lot of people, is to try to make quality decisions up front, invest in things that make sense to you, are relatively, everyone's got their own risk profile, but things that that make sense from a risk perspective to you. Try to make a good investment decision up front, and then honestly, ignore it. like just leave it alone, because compounding, as Nathaniel said, over a long period of time, it's almost imperceptible. That 3% rent increase versus the 2% property tax increase in year one, in year two, in year three, that it's imperceptible. But just like all compounding, eventually you hit this inflection point where it's like, whoa. But you need to give it time. And that, I guess, is that's what I want to say, that individuals have that advantage to sit there and let compounding work for them.
Thank you for that, Moses. I thought that was well said.
Yeah. And no jinx, you don't owe me a soda or anything. I think I got you on that one. Moses, thanks again for us and for sharing your wisdom. And it's always wonderful to see you. We got a lot of this conversation in a couple of weeks when we were in LA. And it's just nice, though, to have a bigger platform for us to be able to share you. So thank you very much for joining us today. And to all those viewing, tuning in to view us, thanks again for doing so. We greatly appreciate your support. And until next time, take care.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.